Greetings everyone and welcome to the Argonaut monthly video covering April 2024. April was a weak month for equities, the first negative month since October 2023, with European markets down 1.5% and US markets down 3.5%. Cracks appeared in the soft landing narrative. Government bond yields rose again, prices fell on multiple data points showing not only that US inflation is sticky, but now is actually re-accelerating. And the benchmark 10-year US Treasuries ended the month at 4.65% yield. That's against 4% at the start of the year and 4.36% at the start of the month. So it's now retraced 2/3 of its gains since October last year, when the yield peaked at 5%. And government bonds on average are now down about 6% year to date. So more uncertainty about whether we're actually going to get any of the rate cuts that the market hoped for, having forecast 6.5 quarter-point rate cuts this year at the beginning of 2024. Fed fund futures now imply only 1 quarter-point cut in November this year. Now, the Argonaut Absolute Return Fund had a positive month, making 0.7% in April, making money from both its long and its short books. And for more details on how we did this, please refer to our April monthly fact. April saw the first negative return for equity markets in 6 months, but the fund generated a modest positive return. Now, we've long been on record as saying that the unique selling point of the fund is our ability to generate returns in more difficult markets, and this is what distinguishes our return from the profile of passive funds and more traditional long-only funds. I want to talk about how we generate that uncorrelated return. You can see that since the launch of the fund, in negative months for the market only, the fund has delivered 80% against the European market down 91% exclusively in those negative months. But focusing purely on the last 5 years, we can see that since the beginning of 2019, in negative months for European equity markets, the performance has actually improved and the fund has actually generated 110% positive return in negative market months only, as against the market, which is down 60% in the same period. Now, since the beginning of 2019, the fund has been, on average, 54% net long, with a ratio of longs to shorts of 2:1. Often, even professional investors struggle to understand how a fund that has had a generous long position has done particularly well in difficult markets, and not only has the highest return over 5 years in the peer group, but also the lowest correlation to equity markets. In fact, we are often asked why we don't run even lower net exposure, particularly as we often express caution about market direction. To which my answer would be, what would be the point, since we already have the lowest correlation to markets in the long-short equity peer group? We want to be uncorrelated, but not negatively correlated. One of the reasons why the fund has had such a low correlation to markets despite a generous net long average position is that our shorts have been in general more volatile than the market, with their higher beta often reflecting their marginal quality. And this has meant that our money for money net needs to be adjusted downward for the higher beta of the short book. The reverse has also been true for the long book, which has typically had lower volatility than the market, reflecting the higher quality of the stocks. Again, we need to revise the beta of the long book down to reflect them. But often we specifically look for longs which might benefit from macroeconomic uncertainty, like gold miners, or geopolitical uncertainty, like defense companies. So it's not just short positions which act as market hedges. But the most important factor for our uncorrelated return profile has been the bang for buck in terms of the alpha from our short book. Despite the bull market in stocks, our return on invested capital on shorts has actually been positive for 4 calendar years in a row. And the return on invested capital of the Argonaut Absolute Return short book has outperformed its expected market return by 90% since the beginning of 2019. So there are many different ways to generate uncorrelated returns. The large industrial hedge fund pod shops have teams of sector analysts running highly levered pairs trades, which are often net neutral in terms of market exposure. We should be clear that this is not what Argonaut does, and it's questionable whether we could even do this in a UCITS world where leverage is rightly limited. With the degree of resource and competition amongst industrial pod shops running sector teams, we believe that this creates opportunity for experienced generalists with variant perception who are able to see the wood from the trees. As often, opportunities are clearer when you can step back from the cognitive bias of so-called experts. The Federal Reserve has a dual mandate of 2% inflation and full employment. Multiple measures of US inflation now suggest that it's stuck between 3 and 4%, whilst the economy already has full employment. The Federal Reserve seems convinced that the recent reacceleration in inflation is seasonal or transitory. Also, the Federal Reserve estimates of the neutral rate of interest fail to consider the fiscal recklessness that has taken place since COVID, which has seen the federal government run unprecedented peacetime fiscal deficits at a time of full employment. On the other hand, the language from the Federal Reserve suggests that in setting monetary policy, it will be particularly sensitive and willing to respond to any weakness in the labour market. For instance, Chairman Powell at the May 1st FOMC not only ruled out rate hikes, but started the process of tapering balance sheet sales from $65 billion of treasuries per month to just $25 billion, with MBS remaining at $35 billion, effectively halving the pace of QT, which will offset the liquidity draining of the reserve repo facility. Although Fed Chairman Powell still talks tough on inflation, it's hard to avoid the conclusion that the Fed is just not that committed to bringing inflation down to the 2% target, particularly in comparison to the commitment to the full employment mandate. Its overtime caveat in bringing inflation down has a similar level of conviction to that of former UK Chancellor Gordon Brown, who was committed to joining the European single currency when the time was right for Britain, in full knowledge that, in his opinion, that time would be never. Politically, of course, full employment is an easier sell than 2% inflation. After all, we have full employment with the still the fastest wage growth since the 1990s, and corporate profits are being buoyed by the nominal boom. So what's not to like? The economist Milton Friedman famously warned about the easy temptation of inflation, comparing it to the early stages of alcoholism.
Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first and the good effects only come later. That's why it's so hard to persist with the cure.
We are currently in a new era of unrestrained government spending. There is still a widespread belief that government spending and market intervention is the solution to almost every conceivable economic, environmental, and societal ill. But greater fiscal policy is the problem, since as a greater proportion of the economy's finite resources are allocated without the discipline of free market profit seeking, productivity stalls, as there is no hierarchy of reward for either perspiration or inspiration. When government expansion is funded by an increase in borrowing, this liability must be paid for, in the absence of retrenchment of productivity growth, by higher future inflation or taxation. Without a political sea change in the role of the state, investors must be prepared for their wealth to either be confiscated by taxation, inflation, or the imposition of capital controls, essentially more rules and regulations about what investors can or can't invest in. Deglobalization, geopolitical conflict, and the subsequent need to rearm will not only require more government spending, but probably more borrowing. In the absence of real economic growth, we worry about how government debt will be funded. During the Eurozone sovereign crisis, President of the ECB, Mario Draghi, famously said that his bank would do whatever it takes to preserve the euro through financial market interventions, which ultimately resulted in large-scale asset purchases. In a non-inflationary world, with the ECB backstopping the solvency of Eurozone sovereigns, the distressed government debt of the so-called pigs proved a very attractive investment opportunity. But what would happen today if the Federal Reserve announced that it would do whatever it takes to get long-term federal government borrowing costs down through a new asset purchase program? With sticky high inflation, it is very likely that after an initial wave of euphoria, the Federal Reserve would soon end up owning nearly the entire Treasury market, as private capital took the opportunity to exit at artificially low yields. Central bank asset purchases are only an effective tool against deflation, not inflation, for addressing solvency concerns. But in injecting more liquidity into an inflationary regime would be like pouring petrol onto a fire. QE cannot work as a funder of profligate governments in an inflationary regime without subsequent hyperinflation. Therefore, the confidence that financial markets still display in omnipotent, if not omniscient, central banks is misplaced. Any whatever it takes commitment to get interest rates down would either involve the retrenchment of the state or raising short-term interest rates, as Chancellor Lamont did in the UK in 1991, causing unemployment and recession as the price we have had to pay to get inflation down. We know no government or independent central bank nowadays, perhaps outside of Argentina, that will be prepared to pay enough of a price to get inflation down. Equity investors used to just worry about the economic cycle and its impact on corporate earnings, but with the knowledge that central banks would eventually provide a put option against a deflationary bust. The problem today is different. We know that reckless fiscal policy and political central banks now prioritize nominal growth. So instead of worrying so much about corporate earnings, there is a price to pay for an absence of recessionary risk, which is higher inflation and higher cost of capital. All financial assets inhabit the real world, where returns must be measured against inflation and cost of capital. Capital and investors, therefore, are uniquely vulnerable to being a victim of the new inflationary political regime, and long-duration capital, whether that's in long-term bonds or growth equities, is that fall guy in the new era of reckless fiscal spending and unsound money. This means that whilst equity investors now enjoy the early stages of alcoholism, the longer-term negative consequences must be lower valuations for all financial assets.